Hey guys, it's Jordan with Cashflow AI, and in this video, we're going to talk about analyzing your results and what are the key metrics for you to know. Now, why performance metrics matter? Well, because you can have two different bots that both have good returns. So let's say bot A has a 30% return, bot B 30% return, but how you get there is also just as important, right? If the max drawdown is 5% and volatility is really low and you have 11 out of 12 winning months, that's amazing. But if you're able to get 30% return with only 7 out of 12 winning months, you lose 40% of your account in the way to get there, and it's extreme volatility. Well, trust me, you would much rather have bot A as opposed to bot B. And so we're going to talk about the metrics that actually get you to get bot A instead of bot B and a higher annual return. And so the problem with the returns is, like I said, just looking at the returns alone tell you nothing. It doesn't show you how much risk you took to get there. It doesn't show you how you got there, right? Again, if you want a steady path and a steady climb to get from point A to point B, as opposed to a roller coaster up and down, extreme, volatile nightmare, that's which one you'd rather have, right? Which one would you rather stick with? Obviously, the steady climb is going to be much better for you. So what are the big three metrics we're going to talk about in this video, and the ones that you need to know when it comes to algorithmic trading, bot trading, and creating a portfolio of trading bots that can last you a lifetime? Well, we have Sharpe ratio, Sortino, and Commer. All right. Now, Sharpe ratio is the return per unit of total risk. So how much are you able to make per how much you're risking? Sortino is return per unit of downside risk. So very similar to Sharpe ratio, but slightly different. And then Commer ratio, right? Your return versus your worst drawdown, best for stress testing your strategies. All right, so let's dive in. So Sharpe ratio is what we call the golden standard, right? This is very simply how much are you getting versus how much you're risking, right? And so the simple math behind this is you take your return minus your risk-free rate, and then you divide that by your standard deviation. So really simple translation, for every 1% of risk I take, how much return do I get? And there's a lot of Sharpe ratio calculators you can input online to be able to find this. And so really you're going to get a number, and it's typically going to be anywhere from 0 to 3 or 5, sometimes higher, sometimes less. But really this is like a golden standard of what you want your Sharpe ratio to be. So anywhere from 1 to 2 is considered acceptable, right? This is like quants, hedge funds can be in this range. This is like okay and decent, but there's room to improve. 2 to 3 is very good, okay? If you have a Sharpe ratio of 2 to 3 across your portfolio, that is good. A lot of top tier hedge funds can get this, and really the best of the best are only able to reach this. And then we have above 3, which is very minimal downside risk. This is extremely good if you have a Sharpe ratio over the long term of above 3. Top tier hedge funds are going to be able to raise billions of dollars if they're able to achieve this. And obviously anything below 1 is not worth the risk, not really worth it at all. You want to find a different strategy. Now, Sortino ratio is very, very similar, right? Now, you can take a look at using Sortino ratio by looking at downside volatility. So let's say we have a bot that makes 18%, except this one, the volatility is about 8%, and this one, the volatility is about 5%. Downside volatility. Well, Sortino ratio is going to be a little bit higher because Sortino only penalizes the losses, where the Sharpe ratio penalizes the ups and the downs. So similar rating to Sharpe ratio, you want to be able to look at these and have a similar Sortino ratio, and that's going to help you move forward from there. Now, what we have now is a Commer ratio. This is what we call the stress test. Now, the Commer ratio is your return divided by your worst drawdown. So you basically just take your annual return and you divide it by your max drawdown, right? So if you make 20% a year and the max your drawdown was for that year was 10%, well, your Commer ratio is going to be 2. Now, why does Commer ratio matter? Well, it tells you if you can stomach the worst case scenario, right? So let's say you have a risky bot that makes you 40% a year. Well, if your max drawdown is 35%, can you handle losing 35% in a year, right? It's a very low Commer of 1.14. But if you have a bot that gets you 25% while only risking 8% on your drawdown, well, now you have a 3.13 Commer ratio. So it's a lot easier to stick with, and you can be a little bit more aggressive depending on how your drawdowns are going to be. And so Commer ratios, again, very similar to Sharpe or Sortino ratios, come in a very simple number. Above 3, you have very shallow drawdowns. This is very good. 2 to 3 is also good. 1 to 2 is not great. You want to strive for something better than that. And obviously less than 1 is not good. You have way too big of drawdowns. You want to be able to manage and change your strategy or slightly tweak it from there. Now, what you want to do is compare all these 3 metrics, right? Now, because you can have the same bot, but all 3 of these will see the bot in a different lens. So Sharpe ratio, again, you can have a very good Sharpe ratio of 2.3. Sortino ratio might be a little bit better at 3.1. Commer ratio 2.8. All of these are really good numbers, so this is going to show a really solid bot, right? Other metrics that matter, and again, these are the most important that you want to look at for optimizing a portfolio of bots. But these are also other metrics that will matter. So like obviously your win rate, you want to shoot for higher win rate strategies, profit factor, average win versus average loser, recovery factor, right? These are all metrics that are very simple to calculate. A lot of them you can see in your dashboard, and that's going to help you, really determine how your strategies are providing for you. Now, red flags on bot performance, right? Warnings that I scream away. And again, these are also basic golden rules that I follow myself. So Sharpe ratio below 1, I don't touch it, not even worth trading. Max drawdown over 25%. I personally put this at about 15%. But you have to know yourself, right? Some people can only handle a 5% drawdown. Some people can handle 30%. I think 15 is a good sweet spot for me. Too good to be true returns, right? If you're able to get 100% returns on a bot with like a 2% drawdown or 3% drawdown, that's just likely not real. You're likely just curve fitting your back tests or overfitting to get those results, and it won't be the same in live trading. And then back testing, obviously, you need to have data to know your results. All these metrics are going to change over time. So you want to make sure you have enough data to see if it's statistically significant, right? So how do you actually choose between bots? Well, for me, I like to look at Sharpe ratio, make sure it's above 1 or 1.5. I want to check the max drawdown, adjust it to be under 15 or 20%, and typically go with the highest Sortino and Comma ratio, right? So let's say we have a quick example here. Which bot would you choose, right? Bot A, 35% return, 18% drawdown. Bot B, 28% return, 9% drawdown. Bot C, 42% return, 28% drawdown. You can see this one has lower Sharpe ratio, Sortino, and Comma ratio. This one has the best. This one has kind of in the middle. Now, you may be asking, Jordan, this doesn't make sense. Why does it matter how I got there? At the end of the day, I would rather have the bot that makes me the most amount of money, which at the end of the day is the end goal. You do want to have, obviously, the bot that optimizes for the most annual return. However, this is not indicative of future returns, right? So even though I'm able to get 42% return, well, if I have a 28% drawdown, let's say next year that this bot doesn't perform as well, the market conditions change, well, this could actually lead to a much higher drawdown and a much less annual return. And so really about picking bots based around the best Sharpe, Sortino, and Comma ratio, it's going to allow you to have a bulletproof system that gets you the best long-term results. So you know that your strategies are not just going to work today, this month, for the next few months, but for the next multiple years to come. And so here is kind of like a final bot selection scorecard you can use to evaluate all your bots before deploying them live, right? Having a very good Sharpe ratio above 1.5 is good. Sortino ratio above 2, Comma ratio above 1.5. Set a number for your max drawdown. Personally, 15 to 20% for me, because I know myself, I know my emotions best. That works for me. It may not be the same for you. Have at least 100 trades in your back test. And for me personally too, I like having win rates above 50%. You don't need this. You can have very profitable strategies with win rates below that. But for me, that's more of a personal preference. So I like to build this for my own scorecard of what I like to trade. So screenshot this, keep this for your collection, build your own scorecard, get after it, and I'll see you all in the next video.